You talked about initially what you call permanent capital. That can mean different things to different people. What did you mean by that?
Let's define capital that's not permanent. Blackstone's capital is not permanent because they've got to return capital to investors through the life of their fund, 8 to 10 years. A hedge fund's capital is not permanent because if they get redemptions on a monthly or quarterly basis, which generally is pro-cyclical, they're getting redeemed on at the best possible times to invest, that's not permanent capital. What is permanent capital? It's capital that cannot be called, that allows you to take advantage of opportunities when the tide goes out and when asset prices are cheap, which is also usually when people have the most fear in the market. So that's one of the reasons why Berkshire Hathaway has an edge over all of private equity. In the 2008 crisis, in October, that crisis unfolded so quickly, private equity did not get a chance to go raise a bank bailout fund. The Oracle of Omaha already had the capital lined up and the planes flew to Omaha and he got sweetheart deals, off-market deals, because he was ready to provide liquidity and inject capital into those kinds of opportunities. So that's what permanent capital helps you do.
I think that's huge. And you just really mentioned arguably the number one benefit that you as a family office have, even if a modest size one, like me, investing in car washes and rolling up and things like that, you do have the opportunity of permanent capital. We have time on our side. Private equity firms need to deploy capital. They need to have an exit. They often, quote unquote, overpay. They also are subject to regulatory issues that family offices may have usually more freedom on. Now, I'm not going to make this a discussion about the Corporate Transparency Act and beneficial owners. My concern is that could segue into the government looking to do more and more disclosures for single family offices, which would take away from the freedoms and liberties and shine. There is no question family offices have a massive advantage there. Number two, you talk about tax efficient. What did you mean by that?
Buffett has three drivers of tax efficiency. One is he does borrow and has an interest tax shield from his borrowing. Now, his borrow cost is very low because he's a AAA rated player, but he takes advantage of what's called an interest rate tax shield. Borrows over $100 billion, by the way. Okay, so that's one. Second, he's got depreciation on the assets that he acquires. That creates another kind of tax shield to insulate from the income generated by his businesses that are cash flowing. So the third is when he acquires a business, he likes businesses that have brands. And when you acquire a business that has a brand, generally you see that reflected in the goodwill of a company, right? So the goodwill is defined as your acquisition price less the marketable value of the securities, of the assets. And that difference is goodwill. It's the price of these intangibles. There's some value that the acquirer assigned here. And that goodwill can be depreciated as well. So there's a reason why Buffett likes brands. Brands have multiple benefits and advantages, whether it's Wrigley's or Coca-Cola or Dairy Queen or NetJets. But one of the other advantages is that you can depreciate the acquisition cost of the brand, even though it's actually helping your business. One other part I want to call out, though, is back to private equity and the difference between Buffett and private equity is private equity firms have to sell their best assets ultimately. Warren Buffett doesn't have to do that. He can hold on to his finest prized crown jewels forever and let them internally compound. Private equity has a clock to them. And private equity has built some incredible businesses. Like Invitation Homes was created by Blackstone. They were birthed in the wake of the 2008 crisis, and they created the asset class of single-family residential homes. And now there's a big capital market around it. There's asset-backed securities financing this asset class. It was a great business. I wouldn't buy it today, but all to say is Blackstone is forced to sell that. Now we have a housing shortage. Those are assets I think they probably would have wanted kept. And actually, Buffett at the time, when Invitations Homes was being built, he said, look, there's one asset I'd want to buy in the aftermath of the 2008 crisis, these single family homes. That's another advantage that Buffett has over private equity.